Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Central bank decisions of Fed, ECB, and the BOE are out. All three continued to maintain rates at the previous levels, but the reaction has been different. After the Fed meeting, dollar fell so even more post the ECB and BOE meetings. Fed was quite dovish in its statement, while BOE and ECB were more cautious. JK, question for you. Yesterday, we had the retail sales data from the US, which came out and showed a decent number. Over the past few weeks, we have had unemployment rates, PMIs, which has been relatively better of the US. But there seems to be a difference in the central bank commentaries. Your thoughts on that?
Hi, good morning, Swaraj. Yes, actually, the CPI number and the unemployment rate as well as the retail sales number, they have been good. But in the background of this, Fed's decision to pivot and moving closer to market expectation on rate cuts for 2024 is a really surprising development. But possibly, I think Fed is probably aware of more about the economy going forward, and it's also probably an election year in which they would like to see the economy stabilize with a lower rate of interest, or rather keep up the momentum, instead of slumping. And I think that's the only reason I can say. And of course, with fiscal position as bad as it is in the US, lower yields would also help the government, moderate their interest costs. And these could be one of the reasons for the recent, Fed to pivot on their interest rate projections for the coming year. Of course, global markets have been super busy having to face monetary policy decisions from three more central banks after the Fed. The rather surprising turn to dovishness by Fed has been followed by cautious stance by ECB and BOE. While keeping rates unchanged, the Bank of England said that monetary policy is likely to need to be restrictive for an extended period of time. And he also said further tightening in monetary policy would be required if there were evidence of more persistent inflationary pressures. Now, his statement that we cannot say that rates have peaked is clearly a contrast to what Powell said. And of course, notwithstanding this, money markets are pricing in 4 quarter point cuts in interest rates from BOE from the summer, anticipating the base rate to come to 4.25 by the end of 2024, the first cut being expected in May. Again, there is a lot of divergence between central bank statements and the market expectations, and the central bank is trying hard to push against that. As for the ECB, they went into a consecutive pause but gave mixed statements on inflation. While inflation has dropped in recent months, it's likely to pick up again in the near term. That's what Lagarde said, and also saying that a lot of indicators showing underlying inflation is below expectations. But she said domestic inflation is hardly budging, and that wage data that they have was not declining as well. They would remain attentive to the data beyond the first half of 2024. Now, despite growing expectations that the ECB will sharply reduce rates to 2024 starting as soon as March, the Governing Council, in its forward guidance, has said that interest rates are at a level that maintained for sufficiently long duration will make a substantial contribution to durably bringing down inflation. Basically, their statements again contrast with what we have heard from Powell or the Fed members. Now, basically, they are also pushing against the market expectation of rate cuts. Now, we had another major central bank, the Swiss National Bank, who were decidedly dovish. And while maintaining interest rates unchanged, they lowered inflation expectations, toned down the need to carry out FX interventions to support the franc's exchange rate. They had been intervening by selling forex reserves to maintain a stronger franc, to see that the inflation, imported inflation, is kept down, and that they have changed itself is a departure from their hawkish stance, which they had been maintaining for some time. Now, even as most CBs are turning or about to turn dovish, the Norwegian central bank raised its policy rate yesterday by 0.25% against market expectation. The Monetary Policy and Financial Stability Committee actually, indicating that the inflation is still requiring some attention. Their inflation fell as low as 3.3% in September, but rebounded to 4% in October and 4.9% in November. It's really a case of a vigilant central bank not taking chances with inflation. Once again, the November retail sales were stronger, and it fits directly into the GDP. Because the control group sales was higher, or rather double the forecast at 0.4%. Now, jobless claims also plummeted to 202,000 from 220,000 forecast, and the lowest since early October. Interestingly, even the continued claims have been on the lower side. So we are again one more mixed bag of data for the labor sector. There have been three top tier data releases, as we observed earlier, that have exceeded economists' median forecasts, jobs, CPI, and retail sales. But the Fed pivot is something which is not gelling with these developments. But we'll wait and see how the numbers come going forward. Yields bounced off the new lows after the hawkish holds by BOE and ECB, with US 10 hitting 3.88 and bouncing to 3.96, 2s hitting 4.28 and bouncing to 4.38, presumably on profit taking. UK and European yields had a sharper bounce, obviously. Fed pivot still reverberating. Stocks had another good day, Dow making a second consecutive record close, S&P and Nasdaq posting smaller gains. Markets do look overbought, even considering the dovish Fed, and fully discounted the good news and ripe for some consolidation. Good thing for stocks is that while rates may ease, economy has showed steady strength, and depicted by yesterday's data as well. So that's what would keep the stock from plummeting, in any big manner. Now, hawkish helped ECB and by ECB and BOE helped Euro and GBP to post strong gains. Euro touched 1.1010. We were trading below 1.08 just 2 days back. Pound sterling hit 1.2795. That's August high. Yen broke through 141 briefly, but has since rebounded. The broad dollar sell-off against other currencies is visible when you look at even the Canadian dollar, which has rallied to 1.34 from 1.38 seen not long ago, despite even the oil being lower. Gold made another attempt at 2050, but just holding below with the profit-taking setting in. In Asia, there has been a spate of numbers from China. Their yuan fixing has been at a new cycle low at 1.0957. They injected almost 800 billion of Chinese yuan into the market, equivalent of 25 basis of rate cut. And we also see their data that macro data from China posting once again a better number. Retail sales at 10.1% versus 7.6% last month. Expectation, of course, was at 12.5. Industrial production at 6.6% versus 4.6 last month, and 5.6% expected. Unemployment rate being steady at 5%. So yuan has been able to hold steady at the lower level of the dollar, and it has helped also the Australian dollar to recover, which is closely linked to the Chinese yuan. While all this is happening, what we're seeing is the rupee not really holding on to any strength. INR traded a few paisa below 83.30 and didn't take much time to trade back at 83.35 with usual bits reappearing. And in this scenario, we need a Fed decision or equivalent perhaps every day to get even rupee peep into new territory below 83.30. But something more sustained has been the movement in forward premium, settling higher at 1.76%, 1.47 rupees. That is based on a renewed widening of differential with US. Yields gapped down and ended 5 basis at 7.19. Stocks, of course, made another new all-time high in India. And data indicates a fresh FII flow of 400 million. The total FII flow for the month has been nearly 6 billion now. Now, after 7 consecutive months of negative growth, WPI also grew by 0.3% positive and big influence coming from the food basket, of course. So we still continue to wait for something that can influence the rupee, slightly bigger on either side, but hopes are diminishing with every day trading at the same, very narrow range. Happy weekend for all of you. Next week, we think market gets less liquid, and either we have very sharp movements because of lack of liquidity, or it may be a very sleepy market. Thank you.
Thank you, JK. And just quickly summarizing the three central bank decisions is that despite decent data from the US, Fed has pivoted to a more dovish stance. BOE and ECB have remained cautious while they haven't mentioned anything about peak rates, which is unlike the Fed, which mentioned that peak rates are in. Now, BOE and ECB also pushed back against any market expectations of dovishness. This hawkish hold led to significant gains for euro and pound, but now there's a broad dollar sell-off as well. Macro data from China is coming out better, showing some improvement, while for the rupee, it's not holding on to any strength, dipping below 83.30 briefly, but weakening once again past post that. Stocks in India made a fresh high, and we are receiving good FII inflows into the markets. That's it from us today. Thanks for listening. Tune in next week for the latest in the financial markets.